welcome to Money Talks. I'm Peter Switzer, and we have one very simple goal, and that's to make you richer. On tonight's show, we test out whether we should fear a global slowdown and a meltdown for stocks. To do this, we have Morgan's chief economist, Michael Knox from Brisbane, and here in the studio is Sarah Hunter, chief economist at BIS Oxford Economics, and Beldirect's Julia Lee will later on join us. Now let's kick off with a short clip from an interview I did last week with the ex-CEO of Westpac and former Federal Treasury Deputy Secretary David Morgan about his new book written by Oliver Brown called David Morgan, An Extraordinary Life. In recent times, he's been rescuing banks around the world with JC Flowers & Co. And this is what is his take on what might be our threats to our economic and monetary welfare going forward. How vulnerable do you think the Australian economy is to all of the international monetary challenges that are out there, which then could compound on the banks?
Right, so I think you put your finger on what is the greatest risk for the Australian economy, and that is its global recession. It's not a real wage breakout, it's not an unsustainable current account deficit, it's not excessive inflation, the traditional homegrown. It'll come from global recession if it comes at all. And again, I think our banking system is quite resilient to that, in better shape than most. And also, Peter, I think our economy is as well. I think we've got low government debt, we've got close to full employment, we've got low inflation, and we have fiscal space in terms of fiscal policy room and conventional monetary policy room that if it does hit, to give some stimulus from those sources.
One area that you would have considered when you're in charge is the level of household debt and the implications on bank balance sheets.
Yes.
Do you think sometimes there's actually exaggerated, the size is big?
Yes.
Are we different in the sense that the Australians' commitment to paying back their loans is really important? but the history's been, we had quite high household debt levels for a long time.
Right.
Is it, even though it's a worrying issue to me, I figure it's something we can get through. But what's your point of view?
I share that point of view, and because we don't have deductibility of mortgage interest for owner-occupied housing, which I think is good tax policy, that is the debt that Australians will seek to pay off quickest. It is the least tax efficient debt. Moreover, on all the analysis that I've seen, and I've seen a lot of it because I stay close to our Australian banking system, that debt, while it's high, it's basically in the right hands, Peter, of people who have the capacity to repay. So I don't want to sound unduly complacent, but it is not something that I lose a lot of sleep over.
And that was David Morgan, and I'll just show you his new book, David Morgan, An Extraordinary Life. And as a guy who was a former child actor and a first grade Richmond footballer who went to university, London School of Economics with people like, well, Mick Jagger, he certainly has had an extraordinary life for a banker. Sarah, thanks for joining us on the set.
Not at all, not at all.
So, were you surprised how relaxed David was about the threats to the Aussie economy?
I mean, I think if we're talking threat in terms of what could trigger a recession, I think he's right. We're a long way away from that, despite a couple of weak prints on GDP. I think there's some volatile factors in there that will disappear, and so we're not as close as that data suggests. So yes, if we're thinking what would get us into recession, it is going to be some kind of global shock, a financial shock that puts our banking system into real trouble, and we get tightening of credit, and it's, you know, GFC Mark II, as it were. I mean, in terms of what could give us a substantial slowdown in the economy, so not a recession but just slower growth. I'm perhaps maybe a bit more concerned about the housing market and house prices, not so much from a consumer spending perspective, but actually from residential construction, and that being an even bigger drag than it's set to be over the next 12, 18 months when you look at some of the leading indicators there. But in terms of an actual recession, I think I'm probably closer to David's stance than perhaps other economists are right now.
Yeah, well, he is pretty smart, but still, we economists do disagree with one another. So just pick up before I go to Michael Knox from Morgan's. So the area that I picked up on, namely house prices and household debt, that is a concerned area for you, and if so, how concerned are you?
I mean, in terms of household debt and debt sustainability, I'm actually not really concerned about that right now, for similar reasons to David. I think when you look at the makeup of that debt and its composition between investor properties, owner-occupied properties, who's leveraged and who's not, and debt interest payments as a proportion of household income, they're actually pretty low at the moment because interest rates are so low.
Yeah.
So servicing that debt is not too much of a challenge for households right now. And as long as we don't get a big increase in interest rates in the near term, it won't be a problem going forward, and it would be very surprising for the RBA to do that. You know, we're actually discussing whether or not they'll cut rates, not if they'll put rates up by 100 basis points or more. So in terms of that being a drag on spending, I'm not really concerned, and I'm somewhat concerned, but not really that concerned about negative wealth effects and their impact on consumer spending. We've done some research on that recently at BIS and have found that actually, with the exception of a few big ticket items like cars, it's not a big drag on consumer spending. So as I said, my concern is primarily in that residential construction space.
Okay, and just give us your view, because you can't open up a newspaper, particularly on the weekends, but some newspapers scaring us about house prices. You guys are entrenched in the property sector. Sydney and Melbourne, what is your call, your team's call or your own personal call on where house prices will probably end up bottoming? Yeah,
so Sydney peak to trough, we're at around 18.5%, and latest core logic is we're down, I think it was 13%, so or more than that actually, because that was the year-to-date number. So we're most of the way there. Melbourne a touch less. We're thinking it's going to be 16, maybe 17%, and but they've fallen by a little bit less than Sydney. So we think in terms of the size of the correction, we're over halfway. It'll take a while for us to bottom because the pace will slow and then we'll bumble along a little bit and then it'll start to rise. But we think we're most of the way through in terms of the peak to trough move. So we're a bit more optimistic than some of the papers.
Yes, well, that's why you don't get headlines in the newspaper. All right, Michael Knox, there you are. Good to see you, Michael. Did you hear David?
Hello, Peter.
Did you hear David Morgan's take on the threats to the Aussie economy?
Yeah, I did, but my views are somewhat different. My views are the major threat is international, and that's from where the country that usually drives our economy, that is to say the US, and we can see that the yield curve is close to inverted, and we would say because it's below the difference between 90-day yields and 10-year bonds is less than 50 basis points, it has inverted for us. And when we look at that, in the last 40 years of data, we get a US recession, or at least a soft landing, 5 to 8 quarters later. So we're going to have a US recession or soft landing between the middle of 2020 and the end of 21. We don't know when. Of course, the Fed knows that too, and that's probably why they've stopped putting up rates. But I went to a present. Yeah, sorry. Okay, mate. Well,
so therefore, like Morgan, you think the threat is more outside than inside the economy. You think the US will be the main cause of a global slowdown and stock markets coming off the boil. But Michael, are you worried in any way about what the house price falls might do to consumer behaviour and economic growth, given the fact we've had 2 slow GDP quarters?
Well, I wrote a piece about the 2 slow GDP quarters, and I noted that this has a lot to do with the way GDP, as we traditionally use it, is calculated. And in the piece I looked at nominal GDP, that is to say in the dollars that we pay taxes in the dollars we get paid in wages, and that was actually growing at 5.5%. And if you took away from that where CPI inflation was, growth was about 3.7%. Now there's a number that actually looks something a bit like that, and that's the GDPI, the GDP income, and by that it's about 3% growth So it's kind of, the problem about the GDP deflator is it goes up when our export prices are going up, when our commodities are actually improving, and it masks any commodity, the effect of commodity improvements on the Australian economy. And I think what's noticeable is that if you look at indexes like the RBA's index of commodity prices, they went up at the end of 17, they've been stable. Now they've started to go up again. And if you want to ask me why I think those commodity prices are going up, again, I'll talk about that separately. But I kind of think that the economy right now in Australia is better than it looks in the GDP numbers because of the anachronistic way in which the GDP deflator works.
Okay. All right, Noxie. Yeah, so we've got to go to a break. When we come back, I want to come back to that particular point. So that's Michael Knox from Morgans in Brisbane. We'll be back in a moment. Julia Lee will join us to talk about her stock selections as a consequence of what she's heard so far. Welcome back, and Julia Lee from Bell Direct joins us with Sarah Hunter from BIS Oxford Economics and Michael Knox in Brisbane from Morgans. Now, you've heard, Julia, what Michael and Sarah both said, and Michael's, I guess, revelation, he believes a recession's coming in 2020 sometime. In between, are you happy to play the market? Do you think the market has upside? Now, I will be going to Noxie on this after you, but do you think that the market has upside? If so, what stocks do you like?
Yes.
The answer is yes, good, tick.
Look, when you think about economic cycles, it's a normal part of the economic cycle that, you know, you move from a rising growth, rising inflation scenario, which is fantastic for equity markets, not so good for bond markets, to the next phase, which is a bit more difficult for equity markets, which we're moving into, and that's slowing growth and still rising inflation. But when you think about the global economy, I guess within the global economy, there are other economies moving differently. So look, the US economy does dominate the global economy, but have a look at, for example, at China's economy. It's on a very different cycle at the moment, where it's probably closer to the bottom rather than the top. And the Shanghai Composite has been one of the best markets in 2019 so far. So look, I've been looking at getting exposure to China either through ETFs like IZZ,
which we've been talking about for the last few months, yes?
Or through Platinum, which, you know, was punished over the last 3 or 4 months because of its underperformance, and its largest holding is in Asia. So look, that's going to start playing in its favour. So whether you play it through direct holdings or through fund managers with exposure to Asia, I think it's definitely time to start diversifying portfolios. And look, if we are looking at a global slowdown and a weaker Aussie dollar, have a look at some of those global leaders, which will benefit from that lower Aussie currency.
Okay, Sarah, you heard what Michael said about the US, you know, likely be heading towards recession in 2020 or so, and the importance of the inverting of the yield curve. Do you largely agree with him? I know he looks like the kind of person you don't want to disagree with, but we do encourage open debate here.
I think I certainly agree the US has already slowed. It's not even heading to a slowdown. It has slowed, full stop. I'm not sure. I think it's definitely going into a recession in 2020. I think the flat yield curve is definitely a warning sign to pay attention to, but there are other warning signs for the economy that aren't flashing red at the moment. The jobs market's still pretty healthy, for instance. The confidence indices look pretty good as well. Spending is still there. We've got the wage growth coming through. All of that that cycle stuff we've just been talking about, their transition through that period is playing out. So I don't think it's guaranteed that they're going to go into a recession, but definitely slower growth. And yeah, they do matter for the world economy, of course. So. Okay.
Well, now, Noxie, if there's one person who could foil you, that would be Donald J. Trump. Now, he needs to win an election in 2020, and he doesn't want a stock market crash or a recession. Is Donald Trump powerful enough to prove you wrong and push your recession into 2021?
Well, I don't want to take up the rest of the time analysing presidential elections since 1950, but there's only one occasion when a party hasn't had 2 successive terms in the White House, and that was Jimmy Carter, who had absolutely a terrible world economy, and as well as that, the American embassy was taken over.
Yeah.
But so I think you know, the history since 1950 is that Trump is going to get re-elected. But I think, see, what the Fed is actually looking at, I said soft landing, what they're trying to do is get a situation you've got, say, growth of about 1.5%, maybe 1.8%. So they slow the economy, but don't actually go into recession. They go into a soft landing, or what some economists call a growth recession, where unemployment is going up, but growth is not yet negative. What they're trying to do is stabilise. Unemployment now in the US is the lowest since 1968-69, and 2/3 of the people watching us weren't born then. So what they're trying to do is get unemployment up to about 4.5% by slowing the economy from 2.9% last year to about 1.8, 1.5. And if they can do that, they think they can keep the economy growing forever. And there's at least a couple of Fed presidents I've seen in person present who've referred to this other miracle country that hasn't had a recession, called Australia. I don't know if they really think that we're what they want to be, but we have avoided recessions for a long period of time.
Yeah. Now, Julia, you said you want to make a comment about what Noxie was talking about then.
Oh, well, one thing I've been struggling with, I guess, is that usually when you see massive amounts of fiscal spending, as we have seen in the US, it's at a time of softness, but we've actually seen it at a time of strength in terms of the US
good point.
economy. So I was just going to ask Michael as well as Sarah, you know, what are their thoughts on the impact that has in terms of the cycle?
Okay, now we do have to go to a break, and we'll come back on that very, very good point, but I'll steal the question, and people who tune in late will think, gee, Switzer's asked a very good question. Coming back in a moment. Welcome back. We're looking at the factors that might create a global slowdown and a stock market meltdown. And so far, the analysis is, well, it's going to be a few years off, but it probably is going to come at some point in time. Now, Noxie, you heard the question that Julia asked about, okay, usually this fiscal spending comes when there's softness. This has come through a period of strength. What are the implications of that?
I went to an excellent presentation by Kevin Hassett, who's the chairman of Trump's Council of Economic Advisors in Atlanta in January, and he talked about the supply side effects of the tax cuts. And he said there were two parts of it. One was the effect on the capital labour ratio, and the other one was on the effect of supply. And both of these effects were to increase output and in fact keep inflation low. The easiest way to understand of the two we talked about was that because of tax cuts on the payroll tax cuts, people coming forward into the workforce in the US are getting higher after-tax salaries, after-tax payments, without there being any additional cost to their employers. So the result of that was that the participation rate is increasing, there's more output in the economy, but no impact on prices. So you've got a supply side effect, which is in fact keeping inflation low. And he also talked about how the increase in the capital labour ratio, which he thinks might go on for another year or two, is also increasing the availability of capital to the market, and that's another supply side effect. So it's really surprising that even though there's been an increase in the budget deficit, those increasing supply side effects is what's keeping inflation low, and yes, surprising me and surprising other economists.
Yeah, and I guess it's the perfect kind of reaction or result from fiscal spending, Sarah?
Yeah, I mean, I think putting to one side the tax cuts, the fiscal spending boost, I think that's more of your traditional, usually used to fight recession spending, that this is a funny time in the cycle for it to be happening. I mean, I think the US is very lucky to obviously hold a quite unique position in the global financial system, in that the dollar is the universal currency. So they don't have to worry about running deficits in the way another economy might, particularly in terms of its impact on interest rates. We're not in a position where there's another currency that can sort of step in and fill the gap in terms of being a reserve currency. So I think when you play that into the mix as well, part of their fiscal boost is potentially has positive supply side impacts, and the rest of it has come through at a time where they don't have to worry about it putting undue pressure on their interest payments and their borrowing costs. They're very lucky, but it is not conventional economics for sure, and it's not a path that another economy could potentially adopt.
Why would you expect conventional economics from a man called Donald Trump? Now, Noxie, before I go, I want to put you and Julian for quick comments. I wrote a story today for the Switzer Report where I thought, well, yeah, the market's gone up by a whole lot. It's about time there's a bit of a sell-off. But when I went through the factors of why you might stay in the market, you got the trade deal that'll be signed. The Fed's not going to raise interest rates, could even cut. Central banks around the world are easing up on the interest rates. You've got China and the EU stimulating. Trump will be trying to avoid a recession and a stock market collapse before the election. You've got below levels. We're below the levels we were when the market started selling off the middle of last year. We've got all these dividend payments, what, 20-odd billion. What are people going to do with those dividend payments? They're going to buy stocks. We've got post-election effects. At the moment, the market's down because of the election, and the election goes away. There should be a bounce there. I've got election giveaways, both the Labor and the coalition will be giving away stuff. And also, this is the most market-watching president of all time. Donald Trump has like 3 TVs in the Oval Office and he's watching Fox Business and CNBC and Bloomberg all day long. Given all that...
Where's my buy button?
Are stocks going to go up this year, Noxie? You first. And make it quick because we're running out of time.
We've got an Australian fair value of 61.50 and we've got a US fair value for the S&P 500 of 2,800. So we've just had a terrific rebound and we are now very, very slightly overvalued. There will be moderate growth, but I think there is upside this year, but because the kick has been so fast already off the low last December, I think it's only modest upside from here. Okay. Sorry, Peter. I didn't mean to disappoint.
Look, Noxie, I don't invite you on to suck up to me. You never have and you never will. All right, Julia, well, you can suck up to me.
I think go with the global leaders. Yeah. They'll be a beneficiary of the lower Australian dollar. Look, the slowdown in terms of the Australian economy, this is natural. So take advantage of it. These times don't come about every year. So use the cycle. I think in the second half of the year, have a look at some of those cyclical stocks as counter-cyclical plays, because cyclical stocks will see the cycle turn.
Okay, well, you did mention IZZ, which is an ETF where you buy the Chinese market, and Platinum that specialises in Asia as well. Is there a local stock that you think looks really well placed, even in a challenging environment as defined by Michael Knox?
Look, I think the commodity space is still looking pretty good here, and that's because of the lower Aussie dollar impact. I think the gold miners should shine in 2019. Once again, Aussie dollar gold, if they're mining here, selling in terms of US dollar product, especially if we get a bit more volatility in terms of markets.
Okay, Sarah, one last thing before we wrap up. Is there anything that we haven't covered that you think is really important that people should be thinking about that could affect their investment and the value of their assets?
Well, I think to agree with the others, I see it as a pretty flat year going forward, but I think you're right that we will get a pickup through the back end of this year globally and domestically, and so that's the time if you're looking at your stocks to pick up those cyclical ones, because they should do well through the back end of the year. Well,
ladies and gentlemen, thanks for joining us on the program. As always, very, very insightful. Now, coming up well, it's basically going to be at the end of April and the beginning of May. The Switzer Strategy Days will be in Sydney, Melbourne and Brisbane. And we will have many of the fund managers you see on this show speaking to us live, and they'll be there to answer your questions as well. If you're keen to come along to the events, go to www.switzerevents.com.au. I'm Peter Switzer. Thanks for joining me.